Peter Esho is with us. Peter is an economist. He is also the chairman at Wealthi. He joins us from Sydney, Australia. Peter, thanks for being with us. Natalia and I were talking a moment ago about this move up in yields right across the curve. I mean, we have U.S. interest rates at levels we have not seen on the long end in nearly 16 years. Tell me what this does to your view on the global economy right now.
I think it's the single most important thing, and sometimes when history occurs, it occurs right in front of our eyes in incremental ways, and we don't know it until after the fact. The U.S. fiscal position, I believe, is the single most important investment theme around the world. The economy is strong. Unemployment is at a rate it hasn't been for, say 40 or 50 years, but the fiscal position continues to deteriorate. The deficit this year continues to widen, and the projections over the next 5 years or so are very, very scary. And so, to me, it kind of makes sense that with increase of supply, with the increase of issuance that's coming, it only makes sense that bond yields are going to tick up higher, and we just hope they don't tick up to a breaking point where they blow out.
So at what level do you think the yields will be really uncomfortable for Jay Powell?
Well, I think if you told people 2 years ago that the 10-year yield will be trading in the mid-fours, they would have laughed at you. And I think if we see, we don't see it because we see the markets moving every day. But I think if you stand back and view it in blocks, I think all of a sudden we're in the mid-fours and the high fours and with a 5 in front of it. And at that point, other ratings agencies start to question. The momentum starts to build. And I think anything above 4 is somewhat indicating that we're heading in that direction. Again, I go back to the underlying basis. You've got the economy at the strongest point it's been for decades, yet the fiscal position continues to deteriorate. And until that fiscal position is addressed, or there's somewhat of a plan, or there's some hard action like we saw in France, for example, which is in a much better fiscal situation, but they took a lot of the pain. It ended up causing riots in the streets, but there's at least a plan there. There's a signal to the market that they're trying to address long-term structural problems, whereas in the U.S., we're going in the opposite direction.
Yeah, so you've talked about one positive, which is that the American economy is holding up well. The negative is clearly the larger federal budget deficits. Another factor is that the Fed is no longer a buyer of U.S. Treasuries. In fact, as that principal comes due on the debt, whether it's U.S. sovereign or mortgage-backed securities, as that principal is returned to the Fed, that money is essentially eliminated. It's taken off the balance sheet and money supply is reduced. How do you view that? Is that a positive or a negative?
Look, that's exactly right. I mean, the central bank is only there to plug liquidity issues when they arise. It's not there, for long-term solutions. And so in order to maintain central bank credibility, in order to maintain currency credibility, those things need to occur. But when you're financing a fiscal deficit that continues to blow out, and just to put it into perspective, the budget deficit this year is projected to be larger than the total size of Spain's economy. I'm sitting here talking to you in Australia. I've got a very different vantage point into Asia. The U.S. budget deficit is going to be greater than the GDP of our economy. And that continues to increase. That continues to worsen. It doesn't actually improve. And there's a presidential election in the U.S. next year. All types of things can happen. And, as that 4 becomes a 5 and that 5 becomes a 6, that starts to eat into the serviceability as new issuances take place. So you're completely right. There's a combination of factors. There is somewhat of an inflation view, I agree, but I'm not seeing it in elevated energy prices. I'm not seeing it in the gold price breaking out. Gold is still trading sub 2,000 an ounce, and if long-term inflation concerns were rising, you would have expected gold to break out. Oil still, Brent's still trading at about $80 a barrel. So I think the elevation in the 10-year yield is purely due to that view on issuances rising and the underlying problem.
Well, I'm glad that you mentioned commodities, because I have a question about China and commodities. We see China is buying more crude, but at the same time, data shows that those flows are not kind of refined in products such as diesel and gasoline. And for me, like the biggest question, is it a signal that Chinese economy is weakening, or there is something else happening in the country in regard to energy?
I think China is, I like to view China outside of the traditional Western prism. Again, sitting here in Australia, we get the best of both worlds. We're in a Western economy, but we're on the doorstep of Asia, and we tend to see somewhat of a different vantage point. To me, what's happening in China at the moment is an intentional strategy to broaden wealth across the economy. There's an underlying plan to broaden out excesses. And I think that, Evergrande going into bankruptcy and a lot of the real estate talk is somewhat intentional. It's managed, but it's intentional because China is trying to broaden out that pie. I like to look at iron ore, because iron ore is our greatest export here in Australia. It is our number one export. It provides a big fiscal buffer to our budget, and the iron ore price is actually strong. The iron ore price is very temperamental on Chinese growth, but it also gives us a little bit of a signal into China, into steel manufacturing capacity. And so the iron ore price has held up relatively well. In terms of energy, it's a little bit more opaque. I completely agree with you. It's a little bit harder to pinpoint, but iron ore and copper is telling us that China's not yet slipping away. And so that gives me some cause for comfort.
We'll see what markets have to say and whether they agree. Peter, thank you so much for joining us. Peter Esho, economist and chairman of Wealthi, joining from Sydney, Australia.